When you save a little bit, make sure you protect what you have before growing it. The first thing I always recommend our parents to buy is once your child is born, get a health plan. Because when a baby is born, the baby is in relatively good health. Within 10 to 15 days, you could actually get the baby insured with a health plan. It covers the baby from 15 days all the way until he's grown up. We can take over the plan and until he's old. Let's say if the kid is 5 versus the kid is 18. When the kid is 18, he or she is going to university in 2 or 3 years' time. That might not be enough time for the value to grow. Versus when my kid is 5, when I buy it now, there's another 10. When you're parents, there's so many commitments that you have to pay for. Make sure the budget is really comfortable and you can maintain it for the next 5 to 10 years, which you have to pay the premium. The most common term insurance Singaporeans are familiar with is the home protection scheme that comes with HDB. Now, when you have a HDB flat, you have your mortgage, you use a CPF to buy this thing called a HPS or home protection scheme. That is a term insurance, meaning for the next 20 or 25 years, if I pass on, it'll help me pay off my loan. If I don't pass on, at the end of the 20 or 25 years, I get nothing out of it. It's one of the cheapest form of protection insurance. The home protection scheme, which is offered by HDB and CPF board, is actually pegged to your HDB. The most common fire insurance is the one that you get it together with your loan or from HDB. That's the basic form of fire insurance. It protects the structure and that's it. It's good to get a home content insurance, and that actually covers you in the event of fire, theft. And the question is, what if the fire breaks out in my neighbor's house? So a home content insurance, it covers you on against fire or floods. So in terms of HDB, there's not much difference. It usually depends on the size of the flat. And if you stay in a landed, maybe there's a greater risk of floods. So these are things to look for. Usually it's the size of the property, the type of the property. And the third one, of course, is whether you're a tenant or a landlord. Investment-linked policies, or call them ILP for short, because it buys into funds, it's an investment-linked product. So it depends on the market. Let's say if you put in 100 to 200 or in critical illness happen, there's still a little payout. First of all is that would you be the one to check whether are your funds doing well? You get your statements regularly. You'll see whether is it performing well. Can you switch your funds? You can always switch your funds. Meaning if I buy A fund and the market is not doing well for A fund now, I could switch to a B fund. But if I'm somebody who doesn't have the investment knowledge, I don't have a trusted advisor, and I just want to take things easy, then maybe an investment-linked plan might not be the best choice for me. I could actually use the amount of money to start off with a term plan to protect myself, then look at some other avenues of growing the money, for example, an endowment plan. So first of all, protect what you have before you grow it. But insurance is still pretty conservative too. So don't expect it to grow 200% like stocks and shares, because that's the higher risk component. Compared to just buying stocks and shares, the risk level is different. So it depends on the risk appetite of each individual.